Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode we can do things a little bit differently. We're going to just take a look at a case that we've actually been looking at since the beginning of the year and do a bit of a deep dive into some of the decisions and thought process that went into that alongside Gareth. So I'm going to lead this one, which is different to the usual format, and Gareth's going to be doing a lot of the answering of the questions. So let's get straight into it. Gareth, good morning.
Morning.
And how are you doing, all right?
Yeah, good. The sun's been shining and the weather's turning, although it's a bit colder today, so we get lulled into a false sense of security. But obviously it's great to be back and chatting through some more property deals.
Yeah, teasing us it is. You'll probably notice, listeners, that I'm the one starting or leading the conversation this week. So something a little bit different. Rather than answering the questions, I'm going to be posing them. And we're also going to do things a little differently, as said, around what we're going to cover in this week's episode, which is going to be, we're actually going to look at a deal that has been on the desk since the beginning of the year, as presented to Gareth in particular. We've been having a look at it together as to some of the pros and cons to it. On the face of it, looks like a particularly interesting transaction, lots to pick apart, and we just thought it useful to go through the due diligence process, the thought process that we adopted, and ultimately then share with you the outcome of the decision that was made in this particular opportunity. So with that in mind, Gareth, do you want to just set the scene, let us know what this deal was and what the opportunity looked like?
Yeah, thanks, Mark. So basically, haven't really bought a huge amount over the last year or two with various things going on with the business and what have you. So kind of felt the time was right to get back into, the market. Seems like there's a good opportunity out there at the moment. There seems to be some deals flying about and things. So I've been up in my conversations with people that I know to try and find some deals. And I went to view something and didn't fall through. And I was chatting to the agent and he was saying, what are you looking for? So I kind of gave him my criteria. Blocks of flats is the main investment strategy, really. And that was that. And then a couple of weeks later, he rang me and said, I've got something that meets all of your criteria. So that was good work. It was quick. And that was that. So, first of all, the key thing is make sure you tell people, that you think can help. But, the old saying is tell everyone what you do, isn't it? So the more people that know what you do, the more chance they've got to bring deals when they land on your desk. The old reticular activating system is in play. And when they think of blocks of flats in this location and in this price range or category or return, then hopefully they'll think of us. So that was the first point. And then the deal itself. So really interesting deal. The block is, first challenge, listed building, grade 2 listed building. It was a block of, it was a former hotel converted into 20 apartments, 2 of which had been sold off on a long lease, which was a bit of it's just a challenge within the deal itself. It's not a deal breaker, but it is a challenge because it's an unbroken block, a broken freehold as opposed to an unbroken one. Now, those people who will listen to the podcast will, know the difference between a block of 20 apartments in a freehold block. So that's a multi-unit freehold block, which is a number of individual apartments, but you own the freehold and there's no leases created. Whereas if you break the freehold, you'd have the freehold and then you'd have the individual leased apartments. So what the developer or the seller in this instance had done, because when they were converting the property from the hotel into flats, they'd actually they run short on cash. So they sold 2 of the properties off on long leaseholds just to free up some cash flow to finish the deal. So that caused a little bit of a problem, but like you said, it's not a deal breaker. So the numbers, just to kind of put some perspective on it, was £1 million they were asking for, close to £1 million for a property which had not been valued that long ago, and there was a commercial valuation at 1.4 million. So first things first, that looks like a decent deal, 400 grand off of a valuation figure that was reported by the mortgage company. The passing rent was 132 grand. So, 132 over $1 million, 13.2% gross yield, which on the face of it sounds like a great deal. So we were very, very interested very quickly. And as with any of these things, you do need to move quickly. So, DD kicks into gear firsthand and 100 miles an hour. Got to jump on these. We did the initial research. We were quite interested. We arranged a viewing as quickly as we could after that, and had a good look around the building. The building was only converted about 4 years ago, so the condition was overall pretty good. There was some external bits, some bits in the garden, and there, a little bit of maintenance to be done, but not massive amounts. There was potential in the basement. There was planning for 2 more flats in the basement, but they hadn't been done. And I'm not sure whether they could be done. They had a quote to do the works, but I'm not sure they could be done because of the lights and things. I'm not sure how building control would have passed those because the bedrooms were underneath and they wouldn't have had any natural light. But they did have planning. So that would have been an interesting one to follow through. So we went through the due diligence. One of the pieces in there, one of the concerns, so broken freehold listed building. The other one, when we had actually managed to get a look at the floor plan, was a couple of the units were particularly small. So one of them, I think, was about 13.8 square meters. So for blocks of individual flats, anything from usually flags anything under 25 square meters. And they were, that's what most lenders kind of want to see, especially for individually sold flats. But they do tend to have, as you know, a bit more flexibility around multi-unit blocks. As long as the majority are of size, then they would consider, if it's an investment purchase, then they would consider some flats smaller than that. But there were a couple in there, and that one particularly quite small.
So with this then, so just on face value, and I'm just putting this in the context of, let's say one of the listeners gets this deal presented to them on face value, then you've got a valuation report in your hand which says 1.4 million. That was valued by a bank, by any measure that is reliable. Obviously the devil's in the detail with everything. But so the reason that the interest was peaked obviously is that valuation report in the hand, purchase price, which, again, by any measure is discounted versus what the current market value is. And I guess there's a bit to understand the rationale behind why they were looking to offload it at 400,000 into the market value. Healthy passing rent, 13.2% yield, which, for a block of residential apartments, residential flats in South Wales, is performing well. I would argue anything over 8 or 9% is probably worth looking at. 13 is sort of this magic number that we sort of put a stake in the ground for a multitude of reasons. So we had that, notwithstanding the fact it was listed, which is only grade 2 as opposed to grade 1. So whilst it does present a challenge, it's not as difficult to deal with. As you said, broken freehold, so 2 of the flats sold off with that. And then, some of the flat sizes were some of the issues as well, which were clearly, because there was already a mortgage on there, hence the valuation, is clearly mortgageable in its current state. So that is another tick in the box as to, hang on, we're not about to step in and buy something that's a monster, as it were, that we can't get done. So tick in lots of different boxes. First instinct is to run around and go, yeah, I got this wonderful deal and what have you. And we do have conversation with clients who come straight to us and go, I've got this valuation report, I can buy for this, I got a 400 grand discount, can you get me a mortgage? What stopped us from just going and getting on with it? What was the next step? So what was the gut, or what was your instinct?
Yeah, so the first thing first on this deal, because they particularly they were pushing for the speed. So they were considering taking this property to auction, and we were going to try and swoop in and buy it before it went to auction. So on the basis that they needed speed, we were looking that we were probably going to consider that we were going to have to buy in cash rather than buy in with with a mortgage, and because purely from a commercial mortgage perspective, take a little bit longer generally than your standard buy-to-let mortgage. So we were just mindful of that, and we didn't want to lose what, on the face of it, looked like a really good deal. So we started speaking with investors, and as we started, as we do, even though we treat investors' funds like bank funds, of course, probably go a little bit further the other way than with it. So we were very mindful, but we had a lot of comfort initially that the fact that there was a valuation there showing the 1.4 million valuation, and that there was this is a strong rent, and everything stacked up. So started going through the deal analyzer, looking at all the various pieces within it, from purchase costs, stamp duty, legal fees, private interest. What else do we look at? Utilities, insurance, listed building, block of flats. So we, get a quote for the insurance, etc. And then when we started breaking it down, we were saying, well, there was something in the gut that was not sitting quite right. And so one of the key, again, another probably a key lesson for anyone, especially because this was an off-market deal and they were pushing to go to auction. You have to kind of start to understand the rationale. So what's the need for the speed? Why are you, generally we talk about especially when clients come to us for auctions, one of the first questions we'll ask them is, why is it going to auction? Is it a probate, straightforward? Is it a repossession? And if it's not one of those two, is it a company disposing of assets maybe? And then, from that, well, usually then it's a property problem. What is the issue? Does it have knotweed subsidence? Is it not mortgageable because of the condition? Or it might be then personal issues where something's happened in their lives that they either need to get rid of a headache, or they need they need cash in quickly. So those are kind of the usual kind of reasons why people would go to auction. And so trying to understand and drill down a little bit more into this started to kind of become a bit clearer, because I couldn't work out on the numbers. It came to light really that they didn't like having to, it was the daughter that was taken over from the father. So she had no real interest in the property. She was living about 2 hours away from the property. So managing it was a bit of a headache. I think the father had fallen out with the previous letting agent and various bits. So there was a few things going on, but I still couldn't quite grasp what the issue was. And I think through a number of conversations, it turned out that ultimately it wasn't making any money. And that got me thinking then around, well, the numbers that have been presented to me, they didn't add up. So as we went into it, through the due diligence, we mentioned the condition of the property was pretty good. They were converted about 4 years ago, and done to a decent standard. So overall, maintenance-wise, yes, there'd be some maintenance on that number of units, but it wasn't anything glaringly obvious apart from some external works that need to be done. EPC ratings there was a couple of C's, but there was a couple of D's and a couple of E's. So that presents it with a problem further down the line potentially. Listed building, sometimes at present there is a potential exemption for listed building, but the government's it doesn't necessarily mean that you will get that, and whether they will change that further down the line. So one eye on that. And then what it turned out, when we got to the bottom of it, it still couldn't quite sit comfortably, but we were trying to move things on. So as we started going through the legal paperwork and getting information through on all of the various pieces, EICRs, gas safeties, etc., it became evident that one floor of the property was serviced by a boiler. The others were powered by electric heating. And it turned out that the boiler was servicing the whole floor. So we were like, oh, well, how does that work? And we started asking more questions. And the boiler was, like I said, well, how is that shared? How is one boiler shared amongst a number of individual units? And I said, oh, the landlord pays that. Oh, that's interesting. Okay, so you start digging a little bit deeper. And what about the electric? Oh, the landlord pays that as well. Right, okay. And then what about, how is the water split? Oh, the landlord pays that. So there's a fair bit of head scratching going on at this point, to the point where we were trying to understand, well, what we have been presented with is a block of 18 apartments, self-contained, planning for self-contained apartments, and a gross rent figure. So I had another look at the valuation report, and the valuation report was based on, anyone who's seen a commercial valuation report is a pretty detailed report, and it had the rent schedule. So I had a look at that, and the valuer had valued the building from an investment purpose on a commercial valuation based on the gross rents. And obviously, well, not obviously, I guess there's a bit of an oversight from the valuer's perspective, but I can understand why the oversight would have happened is because he would have valued, individual units on the basis that the individual units, self-contained, they would all be liable for their own gas, electric, water, etc., council tax, etc., not knowing. And if the applicant hadn't told them that they pay the rent, they pay the utilities rather, out of that gross rent, then they didn't make any deduction for those utilities within the valuation. So the issue that arose was that this valuation of 1.4 million wasn't basically worth the paper it was written on. And when the owner of a property has a valuation report that says it's worth 1.4 million, and you try and educate, and they're already accepting 1 million as a reduction, when you then go and tell them that actually that report isn't worth the paper it's written on, then that's a bit of an issue. So when we went through the exercise and deducted the rent, all the utility costs from the rent, just to come out of the same valuation, I think that brought it down to about 660 in terms of the value, and that was just reducing it by a 10% yield, which is quite close to what the value had given, which for our offer to be the same as based on the same principles that we'd offered originally would have brought our offer down to 550k, which obviously is a significant reduction in where it's at. So that obviously posed a problem because they wanted to get rid of it. They were loss making, I think, on the basis of all the rents and the costs that they were paying out. They didn't have a great relationship, I don't think, with the new agent. So they were actually losing money each month, which is why they wanted to get rid of the property so quickly, plus the distance and everything else. So everything became quite apparent then afterwards when we really dug down into the due diligence. And I guess the point, being is that you just don't take everything for face value. You have to drill into the things yourself, and there was pressure coming on from the other side going, do you want this, are you going to do the deal or not? And I was like, well, yeah, we want to do the deal, but we're not going to do the deal for doing the deal's sake until we're comfortable with our due diligence. And if that takes a bit of extra time to do it, go ahead and put it at auction. And if you can get someone to buy it at that figure, fantastic. But we're not going to be held with a gun to our head saying, you have to buy this, when ultimately we weren't comfortable. And sometimes it's easy to go on the headline figures, and I guess that's the message here is, drill down into the detail.
Yeah, so I think we've got there's loads to unpack, and we obviously picked this particular deal as on purpose to give us something to talk about. But there's lots of lessons and lots of things that sort of demonstrate the point, really, that we've been talking about for months now. So just to unpack some of the stuff that was identified. So valuation report of £1.4 million on a 132,000 rent roll gives them a gross yield of 9.42%, which is what the valuer must have used to get to the 1.4 million. So just under the 10% yield figure, which you said you obviously applied to the now new numbers. Bear that in mind. And this is where understanding the detail, I guess, comes in. So taking the time to properly read the valuation report and asking the question, why? Why? We just want it solved quickly, yes, but why? And keep going until you actually get to the root cause of what that rationale is. In this particular instance, as you say, it was costing them money to hold the property. They wanted it gone, and needed to understand what that is. So With the gross rent, as you say, by unearthing the issue around the utilities, meant that was the wrong figure to be valuing the property on. So it would have been the net, the 132 less 20%, 30%, whatever figure they were going to use, and then multiply that up by the 9.42 would have got you to the figure that you mentioned, which then transpired to be around 550,000 if you're going to follow the same methodology off the back of that. And I guess the important part here is, as well as understanding the methodology that's being used in terms of the valuation report. We cover valuations a lot. We've just done a recent episode, which will come out which actually on recording this would have come out probably, on methodologies as well. So making sure that's the right thing. So sometimes you can take a block, you can take the aggregate value per unit and then apply a block discount. Other times, as this one has, you can take the income and take a yield-based approach to get to the value of it. And so on, the valuer will determine what's most appropriate. Because of your experience, you were able to understand what that methodology was and actually translate that back into pounds and pence. So that was basically, as you say, the valuation report wasn't really worth what it was. Now, the lenders obviously historically lent against it. So what could that mean? That could mean they're potentially over-leveraged on this, depending on the mortgage balance. We haven't got into what that was, but they could be in that position, which meant they had to sell for $1 million. They had no choice because of the outstanding balances and whatnot. The other thing, I don't know if you mentioned this, was we spoke about the potential licensing issues that could come along with this as well because of the shared utilities. Do you want to just go into that a bit more?
Yeah, so this obviously whilst we were looking to purchase in cash because we needed to do that for speed, what we also were trying to come up against then was the exit to pay back the investor in due course. So we were looking at the various mortgage options, and because of the quirk around this, we spoke to a few contacts of ours in various lenders and just kind of try to get an understanding on how they would approach it. And because they couldn't, because of the shared utilities and not being fully self-contained, effectively they would treat it from a mortgage perspective as a HMO. Because if you look at the difference in criteria between a multi-unit freehold block, which are wholly self-contained units which have their own separate utilities, versus a HMO, which is a shared, bedroom, ensuite, or sometimes like a studio type scenario where they might have their own bathroom and a small kitchen area, but they all share the same utilities, that's classed as a HMO. So the difference between the two is the landlord pays the utilities on one and doesn't pay the utilities on the other. And so they would treat that like a HMO. Now, that's the mortgage perspective. Well, then if they were treating it like a HMO, then they would say, well, where's the HMO license? And then, but because this property has planning permission for self-contained units, it doesn't necessarily need a HMO license per se, or does it? So that was the other question in regards to, and again, the difficulty with HMO licensing is that changes from one local authority to the next. So that property in one local authority may not need it, yet in another it may. So again, if it turned out that they didn't have one and that we needed one further down the line, there may have been retrospective works that we would have had to have done to put that in place. Now, because it was a recent conversion, it had a sprinkler system, it had all of the fire alarms and the fire doors and everything. So I don't think there would have been any issues in getting that, but just something to be another kind of red flag that had come up.
Yeah, and then because with that in mind, and we go back to the valuation report, so where I said, one way that you can value a multi-unit block is through the aggregate of per unit values. Then they apply a discount for the block as such. Probably the reason that this made more sense, it was on a commercial investment, despite the valuer perhaps missing it was a shared utility, is the reality is they can't be split into and sold off as individual units because they don't have their own utility supply. Therefore, you have to, you can use that as an indicator, but ultimately it's based on its income because it's technically being utilised as a HMO in effect. So,
and that's the real difficult thing about this. Like you said, there's no one of the key things from a valuer and a mortgage company's perspective is having options should they need to repossess. And if they've lent on a multi-unit block basis, they go, well, we could sell it as a block, or if we really wanted to, we could, split the titles ourselves and sell the units off individually. It gives them options. Whereas in this example, that wasn't an option. So was that a mistake from the valuer? Potentially. Was it the applicant not sharing all the information? Maybe they just didn't think it was necessary and they weren't asked the question. And so it's just a bit of oversight, I think, probably on both parties. However, I think they managed to, the numbers, I don't know the exact numbers, but I think I have a rough feeling around the numbers that I don't think in this example that it cost them, because I don't think they were over leveraged, but that could have ended them up in a real difficult position. And that would have been interesting to see where that had ended up had they have been.
Yeah, and we also talk about, so in this particular scenario, we weren't going to be using a bridge lender, we weren't going to be using a mortgage company. This was investor funds. For all intents and purposes, you can speak to the investor with your £1.4 million valuation as your evidence as to the rationale and what you're trying to achieve and deliver and so on and so forth. And probably could have deployed their monies with very little friction from the investor because of experience and all the evidence that comes there. And could have ended up in a very difficult position later on. So I guess what the point I'm trying to get to is it's even more important when it's not, because a mortgage lender would, you think, of do the due diligence as would the bridge lender and dig into this and get a new valuation report and so on and so forth. But you were reliant on the 1.4 million valuation report from 2024. So it was relatively new, not enough has happened in the market to completely destroy that valuation report, and investors consider differently. So I guess this speaks to the importance of really knowing what you're doing, because that could have gone horribly wrong had the due diligence not been done in the way that it was done.
Yeah, and that's it. Ultimately we've got a reputation to uphold, but also we treat it as if it was our own money, and would we put that money into the deal? And with all of this, I think it just comes back to being really comfortable and digging down into the detail on everything, so that you are going in eyes wide open. Because ultimately, the worst, what we don't want is to get into a deal and then find that we can't repay it because something that we could have done and we could have found out up front wasn't. We found out later, and that meant the deal had changed, pretty significantly. So yeah, I think it's just, like we said, we talk about the importance of due diligence all the time. So just make sure you do as much as you can, really.
Yeah, and I get this particular deal emphasizes the point. So when's a good deal not a good deal? And this is it. So on the face of it, as you say, good returns, discounted purchase price, so below market value, which everybody's kind of looking for on the face of it. But when you actually dug down to it, there was a fundamental error sitting in the valuation report, or the value behind it. The seller was trying to get rid of it because they were making a loss on it. So actually what was going to need to be done differently so that it wasn't making a loss, possibly down to the purchase price and various different things. I guess there is a deal to be done. I guess the question is what level is the seller prepared to go down to offload it, to get rid of it? And equally, what level are you prepared to pay? And is that gap too much of a gap to bridge?
Yeah, and again, when is a good deal is, when you know your own criteria, then you'll know what that looks like. And again, that's something that we've harped on about a fair bit on this show. And ultimately, once we educated the vendor on the issue with that valuation report, which everything was pegged on, just with that misrepresentation, based on what we were seeing, that brought the valuation down to 660 just by capitalizing those costs. And then we made our offer then, which we knew they weren't going to accept. But again, another old thing within property investing circles is always offer. And so, we offered 550. We knew they weren't going to accept, but the offer was on the table. Sometimes, and this is the thing, is, around following up as well. So when you do make offers, just make sure you do follow up, because their circumstances change and various things. they did. I'm aware that they have since sold, and that figure was closer to about 770, 775, something like that. I don't know the exact figures, but it just goes to show how much they did come down. And for the person buying, that could have been a good deal, as long as they were they did their due diligence and they were comfortable with the numbers, and we may have reviewed it a bit more, but ultimately it didn't fit within what we wanted. There's other opportunities out there, and we'll just keep looking for things that do match our criteria. And it is quite an aggressive criteria, which makes it more difficult to find deals, and that's where it becomes an issue then in terms of finding them and not getting sucked into doing deals for the sake of doing deals.
Yeah, and there's temptation there that the criteria can creep. So if you set your line at 13, 12 and a half, yeah, that's close enough. Actually, now it's 12. We've been on this for a month now, so yeah, 12 is all right. And then before and you can creep and creep and creep, but and this could have happened quite easy. All right, the numbers would have changed significantly, of course, but there is that temptation to go, it's still a good opportunity if we can pay this much for it, and then you starting to fall outside of your own criteria to make the deal fit, and it speaks back to not being a motivated buyer because you just, I've got this wonderful deal. Again, the objective was to get X number of units done in a year. This would have smashed that plan out of the water in one fell swoop, and ticked a lot of other boxes. So, you go, see, I could get my objective for the year done by mid-Feb at this rate. But yeah, lo and behold, the devil's in the detail, as we always say, to walk away from it. So that creep is a thing, because you can very easily go, yeah, I'll tolerate 2% less.
Yeah, and also, to put the shoe on the other foot, it's it depends on, again, your circumstances. How many other deals have you got? What else have you got going on in your in your life and various bits? Where's the cash coming from and things? And I think there is, we see this as well with clients, from a analysis paralysis and a too cautious, and then a too cautious that don't do any deals at all. And so there is a fair line that needs to be drawn, and I think you can, you need to allow some tolerance, because what you don't want is the opposite of buyer's remorse, is non-buyer's remorse, and then you turn around and go a few years later and go, look, I should have bought that property, which I'm sure there's plenty of investors out there that will have done that as well. So yeah, if a good opportunity is there, take it, but don't get duped into buying something that's not what it seems on face value.
Yeah, and look, hindsight's a wonderful thing, and all those bits and pieces. But when you look at this as well, as it crept, let's even if it's a couple of percent, you've got things down the road as well, which are going to come. I'm going to erode that margin in 2-3 years' time, EPC ratings and bits and pieces. So when you look at it as a collective, it wasn't just a creep in the percentage return, it was a creep in the values. They were moving parts which you go, and actually, you know what, this is outside of the risk profile now. Yeah. The tolerance, where the money's coming from. But more importantly, as we say, is the exit strategy was massively under threat if it didn't go in at the right purchase price. Otherwise, that money's locked in there for a long period, and that would have been worse than buying something that wasn't profitable.
And one of those thought processes is, right, what are the things that you can influence in a deal? So you can influence like rents, so income. How do I influence the income? And they were already at the top end, and so I couldn't really influence that, albeit now it's clear why it was at the top end, because that was including bills. Costs, how can you influence costs? Well, they're paying gas and electric. Those costs have since the beginning of the year obviously increased with everything that's going on in the Middle East. So that wouldn't have been aware, wouldn't have been aware of that at that time. So it's really difficult to control utility costs. Your management fees, your maintenance, those things, you voids, you can't really influence those too much. So mortgage rates are mortgage rates. You can't influence those too much either. So the only thing that you've got left to influence is the purchase price. And again, this is, again, another investing philosophy, isn't it? You make your money when you buy. And so, the key thing you can influence is the purchase price. And then you have to go, well, I have to walk away at this price, and so be it. So, yeah, so we did. And spent a bit of time on it, as you'd say, but this is the process. You have to go through the process. You have to tick all the boxes, and if you've got to walk away, you've got to walk away.
Yeah, and there's learnings in all of it, isn't it? Is that actually from off the back of that, we since have spoken to, I think, 3 or 4 clients that have been doing multi-unit blocks that have got shared utilities involved. That I don't know what it is, that reticular whatever must have kicked right in, because we all just went, and the advisors as well, like, hang on, it's got shared utilities. This isn't a multi-unit freehold block. We've seen those, found them all since that. So
so that's just something to think about, isn't it? Where one of the examples was a house. It was at end of terrace. The previous owner had added a 2-story extension on the side and effectively created another property with an annex. Had added the electric and gas, but not the water, and so that the water was being paid by the neighbour, probably unaware that they're paying for next door's water. That one is paying rent, and they've just never had a water bill because it's coming through, and it's all quite bizarre. But the crux of the matter is, if that was from a mortgage perspective, that would get picked up, and that would get picked up at legals, and that's right at the end of the process, in which case they probably spent money on valuations, legals, and fees and various things. So it's just how many of these things can you pick up right to the front end of the process to avoid the headache, the time waste, the cost, the opportunity cost as well.
And I think ultimately, aside, if we look at this particular deal, the number one thing that probably broke this, aside from the other bits, which are probably manageable to be fair, was the utilities issue, because that materially changed the value, made it loss-making, et cetera, et cetera. So yeah, there's that to consider there. So look, I think we've gone through this in good detail. It's a good example of a deal that on the face of it looked really, really attractive, really interesting. Through the process of due diligence, identified that it ultimately wasn't a deal at that level. Made an offer, always making an offer. So made an offer at the level that it did work. All right, it didn't proceed based on that offer and somebody else won it, but he lived to fight another day. Look at the next deal, run through the same process, and hopefully, eventually one of them will come through and meet the criteria and get us over the line so that we can, get that sorted ASAP. So I think there's plenty of lessons in that. So thanks for sharing that. We appreciate it.
A pleasure.
And from a listener's perspective, if you've got any questions, as always, just drop us a line. We happily go through some of the scenarios that we see. We effectively can run a deal clinic on the phone with you. So if you've got your deal and you want to chat it through, is it financeable and so on and so forth, then please do get in touch. But until now, thank you very much. Really appreciate your time, and we'll catch you on the next episode.
Thanks, Mark. See you guys. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested, and of course subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.